Joining us now is Emily Roland, John Hancock Investment Management, Co-Chief Investment Strategist. Emily, I don't know if I talked about you a little bit earlier because of some of your comments. You think that that the risks of recession really are increasing. Maybe we're not, are we at 50 yet or just up? If we were at 10, where are we now?
Yeah, we're getting there, maybe a 7 or 8. We're still in this sort of never-ending late cycle environment where the lagged impact of Fed tightening hasn't tipped us into contraction yet. You are seeing, of course, some cracks in the labor market, a decelerating economic growth backdrop, but it hasn't shown up in earnings. There's a lot of smoking guns as it relates to this drawdown we've seen in equity markets, but you can't blame earnings. And over time, stock prices follow profits. S&P 500 is coming in at 12% earnings growth year over year, an 80% beat rate. I just think there was such impressive price action coming into this earnings season that you almost had to be perfect. It reminds me, I keep thinking of that image of that pole vaulter that's representing Sweden that keeps breaking those world records at the Olympics. That's almost what you've had to do as a company heading into this earnings season.
I was actually talking about that, too, because I've been watching pole vaulting my whole life, and I can't believe the human spirit. A world record's a world record. So the world record that was unbelievable 20 years ago, suddenly we're still getting higher and higher and higher. Yeah, I saw that. That was amazing. And he could have cleared it by even more than what he cleared it by, I think. Yeah. So I think in terms of Olympics now, too, for some reason. So the earnings were, I don't know what you'd give it. You wouldn't win a gold medal from there. I don't even know if you'd medal with the earnings we saw from tech in this latest season. Would you even be on the podium? I don't even think you'd be on the podium. They were okay, but they weren't as good as what the price action would have needed to maintain it.
Yeah, I mean, I think you'd be pretty close, if not on the podium. Again, the valuations within tech had gotten extremely frothy. The S&P 500 at one point was growth index was trading at about 50% higher than its 20-year average. So again, the earnings are there. You look at communication services this quarter coming in at 22% earnings growth. The classic tech sector coming in at 12% earnings growth. There's not a lot to complain about there. Yes, maybe not a gold medal, but pretty darn good. I think you saw some technical elements driving the sell-off. Of course, the unwind of the yen carry trade. That softer data creating a growth scare, but it was likely overdone. And it was something that we should have expected with markets going pretty much nowhere but up.
But intermediate term, I think you say we may have come to the end of the longest late cycle period in history and could soon be moving to a recession. You're underweight stocks and overweight bonds now, are you not?
Modestly, yes. So we do think that ultimately the lagged impact of Fed tightening will tip us into contraction. But the one thing that's kept us in this late cycle environment is that we've been spending like crazy. In fact, we've increased the size of the deficit to almost 7% of GDP, which is unheard of in an environment where we're still not at 2% inflation. The labor market still remains fairly robust here. So we've extended the cycle. But we actually see the impact of that fiscal stimulus fading as we head into next year. And we do think those cracks in the labor market are going to get bigger as companies contend with margin pressure. Top line revenue growth is slowing. Cost of capital remains elevated. Margins are getting squeezed. And we do think companies are going to need to lay off workers. So we want to emphasize the income that's now available in high quality bonds. Of course, a lot of that has dissipated in the last week or so, but we would be looking at every backup in bond yields as an opportunity to lean in to that income that's available. We still like stocks. We're looking at quality at a reasonable price. We want companies with great balance sheets, tons of cash, low interest burdens, and the ability to protect those profit margins.
So when history is written about the Fed and how they handled this, will the Fed have the soft landing? Will they stick that, or will they take a step back, or will they just fall on their tuchus? What?
It's possible, but if you're betting on a soft landing, you're betting against the odds. If you look back at history, the only time the Fed's nailed it really was the mid-1990s, but that was a period in which inflation had not run away and economic growth was actually decent, and the Fed got ahead of it. back in the late 1990s. So we think it's going to be tough to nail that soft landing. That doesn't mean we need to have a horrible recession, but we do need to have a resetting, and that's got to show up in valuations as well.